All right. Good afternoon, good morning, good evening, everyone. Gonna get right in here, going over point figure from the very top. And I'm not going to really take any questions because I'm just going to go through this and then let YouTube process it. And I'm going to post it. I'm going to sticky it in the channel. So there we go. So point and figure charting is the price action traders Pierce chart form. I'm also going to try to eliminate any going off of the rails and on a tangent. So I'll just try and keep it as close to on topic as I can. But point figure charting looks like this whole bunch of X's and O's, looks very different than candlesticks. One of the things that makes point figure very different from any other chart style is that it is. Sorry, I thought something was broken. My desk here. It is lacking a time factor and there's no volume. So Japanese candlesticks, for example, or American bar charts, they're considered three-dimensional, meaning that there's a time, price, and a volume component. Uh, we do not have that with point figure. It is just price. So when people are saying they're price action traders and they're not using a price action style chart like Kagi charts, scan swing charts, point figure, Renko, that's price action trading. That is price action chart. Those are price action charts. The others are for analysis purposes. That's my. I think in my I look at chart styles as either they're meant for analysis or they're for trading. So point and figure is and always will be an intraday charting method. That's very true. This is the only chart style that was. Uh, I mean, there's been variations of point and figure throughout different civilizations, going back to antiquity. Um, there's variations of it all over the globe. Different civilizations have had it because people have always wanted to know the cost of something, and commodities have always been something people pay attention to. But it is an intraday charting method. It's not for like month out planning. It is meant for intraday trading, which is very different from Japanese candlesticks. Candlesticks were never meant for intraday trading. In fact, they were almost really never meant for anything under a 3 day or a weekly chart. Since it was introduced to the West, that's kind of something that we've done. That was not the intention, and it's no wonder people have struggled to find success with Japanese candlesticks, because you're not using it the way that it was intended. But price action traders. This is the Pierce. This is a price action traders Pierce chart form, and you do need intraday data. Thankfully, with forex markets and crypto markets, the data is free. Otherwise, if you use the stock market or futures, you have to pay those data fees. So this is from Kirkpatrick and Dahlquist's book Technical Analysis, the third edition, maybe second edition. I don't remember. Anyways, what they wrote is that point figure charts have neither time nor volume. They're considered irrelevant to the point figure advocate. Price is all that the analyst is interested in. In this sense, a point figure technical analyst is a Pierce, and that's very true. I'm a GAN analyst as well, and which is they're very complement. GAN focused on time. He focused on price a little bit, but he was more concerned about time. And point and figure focuses only on price. But both GANists and point and figure traders, they share this trait. News doesn't matter. All right. News only matters if price moved. If price didn't move, the news came out. The news that comes out doesn't matter. And there's examples of it. In fact, there's a. I'm just looking on my bookshelf. There's behavioral economics or behavioral finance. There's a whole field of study in this where in a nutshell, there has never been a major news event that has ever terminated or begun a new trend in financial markets. And that's because, as technical analysts, and if you're going to be using technical analysis as the primary form of trading, you better get used to this fact that markets are a natural phenomena. They move in their own kind of way, and you have to learn the patterns and the cycles and capitalize on it. And once you start, getting rid of the news, you will end up being a lot more calm too. All right. So X's and O's. And if you're only familiar with Japanese candlesticks, this can look a little intimidating because it looks very different. But the easiest way to think about this, the easiest way to think about this is that the green columns of X's are like green candlesticks, and the red columns of O's are like red candlesticks. Okay, X's show price moving up. So X's like a green candlestick. The open is at the bottom, the close is at the top. And just like red candlesticks, the column of O's, the price starts at the top of that column of O's and ends at the bottom. All right. So price X columns are prices moving up, O's are prices moving down. And there's the thing I'm getting away from. Now, box size and reversal amount. Okay. So the box size, depending on the chart software you use, it's different from platform to platform, um, how you input this. But I'm going to show you how to do it in TradingView because this is something people always want to know. So when you open up a new chart in TradingView, it might look like this. All right, and what you're going to want to do, I'm on the euro dollar, so if you don't have that on your list, you can always hit this plus sign and type in EURUSD. And there you go. So, what do we got? Cool. That's what you want to do there. Put the euro dollar there, and then you can kind of just minimize that. Now, what we want to do is get rid of that volume. We don't need it. It should be below the ticker data here. And then we want to go to a point figure chart. So up top, you should see this thing that looks like a candlestick with a pull down menu, and you want to click on point and figure. Now you're going to look, it looks kind of wonky. So there's a couple ways you can get to this next step. You can either double click anywhere on the X's or O's, or right click somewhere in the open space and go to settings. Go to settings, and you should be at the symbol. And then what we want to do is we want to go to box assignment method, and we want to go to traditional, not ATR. And without going into a ton of detail, the reason that TradingView does this is because of how it. I mean, I won't get into it. Just this is what you have to do with TradingView. Other software, similar things you would have to do, but ATR, average to range, we don't want that. We want traditional. And then, I don't know what it'll do for on your screen, but then you have box size. So we're going to go to like a 5 pip chart. All right. So 0.0005. So for foreign currencies, non-yen pairs, at least for the euro dollar, that is a 5 pip chart. Then we want to go to scales. And you'll see this down here is the lock price to bar ratio. We want to check that, and we want to make that 5 pips as well. Because then what happens is we can zoom out and zoom in, and we're not all over the place. And then we want to get off the daily and go to the 1 minute chart, or you can go to the 1 second if you have it, but the 1 minute chart, and that should be that. Now, when it comes to other markets, let me figure out where that is at. I had where? Okay, yep. Sorry, this was a little out of order there. So for Forex, for box sizes, because people don't trade just for, I mean, a lot of people don't trade just Forex, but these are the box sizes. So for Forex pairs, I use 3 box sizes: the 20, the 10, and the 5. Now, if you're using like the ES or the NQ, these are futures contracts. CL is crude oil, gold. You would put in not 0 point something. You would type in like 25 ticks, or that would be 5 points, or 50 ticks is. I don't know what that 3 is there. There's a typo on my part. But these are the values that you would put in for these markets that I use. For Bitcoin, the box size, you would put in like $1,000 box size, or 500 or 250. Why do I pick these? Because I mean, you'll find out with instrument that you trade that you know you don't want an instrument that looks like this. Um, when we go to one sec here, it's the reversal amount. Go back here. We don't want it to look like um, this. Like this is not a very good chart. All right, why? Because it's they're way too big. They're all over the place. Um, Even if we went to like a weekly, it would look even more ridiculous. So yeah, we don't want that. Um, and we don't want the box size. You know, the box size, if it's too big, you're just not going to see anything happen really. So if we do like a 100 pip box size chart, I mean, yeah, there's activity, but I mean, you can see how long it takes for things to show up. Like this column of X's formed on the 29th of May. The first three box reversal showed up on the 29th of May 2020, and then the next column of O's didn't show up till February of 2021. So you'd be waiting a long time on a 100 pip three box reversal chart. That is that. So that's just how that works. Okay, going back to our slide. So box size and reversal amount. So the box size is telling us how many pips each X and O represents. So if the box size is 20 and there are 5 X's or O's in that column, how many pips is that? 5 X's times 20 pips is 100 pips. All right. And the reversal amount, this is the one that always gets people confused, and it's actually a lot easier to show you than to try and explain it, because it's one of these things that you could go through the definition, but that doesn't mean you grasp it very easily. At least I didn't. I mean, and I assume I'm kind of like everybody else, where mostly I'm a visual person. But the reversal amount, the definition is the number of boxes required for a new column of X's or O's to form. Now, I did a recording of this. Yeah, we don't need that. And so we'll see here. So this is the column of O's, and I did this on a 1 pip 3 box reversal chart back in, I don't remember when, but yeah, don't use that. But this is going to show you what the 3 box reversal looks like, because a column of O's is here, and the 3 box reversal means that price so it's at 119.63, and so the euro dollar would have to move up to 1964, 1965, 1966. Once it hits there and it closes on that minute chart, then we'll see 3 X's show up at the same time. That's the only time you'll see more than one box show up at the same time. It's on the reversal. So if I hit the play button and we're just kind of looking at the screen, and this is what you do with point figure. It's really, really exciting. It actually is exciting. But once we see it move up to the price level that it 3 boxes above that last O, we'll see the 3 X's pop up. And that's what it looks like. All right. Very exciting. Absolutely thrilling. That's what happens. Then what does it look like, when the market is actually moving? So this is on a 1/2 pip 3 box reversal chart. You would never use this, but this is just to show you what it looks like in a point figure market when it's moving. Now, you're noticing that some of the O's show up and then they disappear. They show up and they disappear. That's because, and this is a trading view thing, it only prints things on the screen after a certain period of time has passed. The thing is that the experts really haven't come to a big consensus on if this is a big deal or not. I think it is a big deal, but in practice, I haven't that hasn't proven to be a big deal. Because if you were like an old commodity trader, or if you were trading in the pits in Chicago, you didn't have these indicators and charts and stuff. All you had was price, and so you had your little point and figure chart with you, and you would just write down X's and O's. So you did it live. You weren't erasing O's and X's. Wherever it moved, that's where it was at. So that's just kind of the annoying part of some charting software. Now, what is awesome about point figures, that the signals are clear and unambiguous. And to make that point, maybe just think of it, which chart looks clearer. Okay, both of the charts, the candlestick chart on the left and the point figure chart on the right, both are of the Australian dollar. AUD, the Australian dollar, US dollar, the AUD, USD, or sometimes you just call it the Aussie. And there's a black vertical line on both charts, both showing the same date, basically. There's no time factor in point and figure, so it's not the exact same date, but it's showing the price action that occurred after that black vertical line. And when you look at the candlestick chart, like I can trade candlesticks. I've had to trade for different prop shops where that's what they want you to use, and I'm not a very good candlestick trader. I use candlesticks 90% of the time. 90% of my day is looking at candlesticks for analysis reasons. But I try not to use them to trade. Um, that's what point figure is for. But when I look at the chart on the left, all right, and if you're like me, if you have an anxiety disorder, um, this shit makes me go like panic attack mode. The chart on the left, there are so many reasons why you would get in or out of that market. Uh, it's just a nightmare. Versus what's happening on the left, there's like 3 trades that you ever would have taken on the chart on the right. It's just a lot cleaner. It's a lot clearer. There's not as much noise. It's just a lot more. It doesn't generate as much stress. That's the point. And when you're trading, that's what you want the least of, is more stress. And folks, Japanese candlesticks, they excel at generating stress, and it's kind of one of the reasons that brokers encourage the use of them, and they don't encourage the use of point figure. So we enter trades. The setups with point figure are mostly off of the breaks of double tops and double bottoms, triple tops, multiple tops and multiple bottoms. That's how most of the trades work. Not all of them, but 80% of the setups. And there's only a few patterns. There's several patterns in point and figure. It's not like Japanese candlesticks. I teach like 8 point and figure patterns. And if that sounds like a lot, it's not, because oh my gosh, well, Thomas Bulkowski has a book called The Encyclopedia of Chart Patterns. It's like 600 pages long, and there's hundreds of chart patterns in there. And then you have Japanese candlestick patterns themselves, of which there's like 230 plus. So, I mean, 8 is a lot more manageable, and they're good in every single market. Uh, there's the double bottom, and then the short entry is the breakdown below that. And this is the other thing I think new people struggle with, is that we're always told before we get into trading, like people always say buy low, sell high. I just make, like, I have one of the Wall Street Bets silver coins, and it's like a joke, is that buy high, sell higher. With point figure, that is what you do a lot of. You do buy the breakouts above tops, and you do short the bottoms of multiple bottoms. So that is a thing you do, and it seems very, very opposite to what you should do, because we're always told, like, buy low, sell high. Well, that's great in theory, but this, in practice, it's a little bit more difficult. So there's that double top, and then the entry is that one box above it. There's triple tops. By the way, the only time that you would ever take an entry on a double top or a double bottom is if it's part of a pattern. But triple tops and triple bottoms, those are patterns themselves, and they are. I mean, if the market's good for it, and if it's appropriate, they're good to go. Triple bottom, boom, there. And yeah, so that's just, we're gonna go through the patterns in this recording too. So you can draw trend lines if you want to. I typically only teach and use 45-degree trend lines. And here's the nice thing about trend lines is, with candlesticks, it's always a question of, oh my gosh, where do I draw this candlestick at? Do I use the wick? Do I use the body? Oh Lord, what do I do? With point figure, yeah, you can use subjective trend lines. So, oh, let me drop this down to like, let me go over here. So subjective trend lines, what I mean by that are trend lines that you would really use like in candlesticks, where you're like, okay, here's a swing low, there's a swing low there. That's what you're looking at, or you're like, okay, here these are connecting these highs and so forth. Um, those are subjective trend lines. But with point and figure, we use mostly we use, or I use, I should say, mostly I use 45-degree trend lines, and they're very easy. And these trend lines tell you whether the market is in a bull market or a bear market, because with point and figure, you are always in a bull market or a bear market, and it's very common to switch those. I know when we think of bull markets and bear markets, we think of, macro time frames of several quarters or years worth of that, but with point figure, we don't. It's not uncommon if you're trading like on a 5 pip 3 box reversal chart to switch from bull to bear several times in a week. That is perfectly normal. But how we draw 45-degree trend lines is quite simple. We just start with this low here, and then we draw it to that next X. And to get the trend line to do this, the trend line tool, double click on it. On style, hit extend right, extend the right line, and that will bring it across the screen. That's what you want. You want it to extend across the screen. Um, And this also helps us establish whether it's bullish or bearish. How do you do that? Well, we take the 45-degree angle and we can go back. You actually kind of want to start like the last swing high. If you look at a chart like this and you're wondering, is this in a bull market or bear market with point figure? We want to figure that out. Okay, so here's the high of the last swing. And if I go like this, prices were trading below it. So it wasn't a bear market until it broke out above. Now it's no longer in a bear market, it's in a bull market. And this is the angle moving to the top right. That is the trend, that is the market direction up, because it's a bull market. And it will remain that way until price breaks down below this one. And you can kind of see how this happens, over time quite frequently. And it can get a little choppy. So here it was in a bull market until over here. So the last swing high was back over here, and things were like going okay, and then they switched back again. So it can be a little messy, and that's. And I don't. I know people have asked me before. Do I use this a lot myself? Um, I don't weigh that crazy heavy. I mean, I want to know where the line is at, but I mean that's something for another conversation. So let's just get back into it. So 45-degree trend lines, the same patterns that you see in candlesticks and American bar charts, the flags and pennants, you're going to see those show up in point and figure as well. Head and shoulders patterns too, they're going to show up. But if you're going to trade them, we don't enter them at the break of the trend line of those patterns. We enter at the break of a multiple top or the break of a multiple bottom. That's what we do with point figure with patterns. We went through the box sizes. I'm not going to go through the profit target stuff. That I've learned that is just a little too much. So let's get into the chart patterns themselves. This is what people really want. So the first one we're going to look at is called a catapult. There are bullish catapults and bearish catapults. I show mostly the bullish ones, but the bearish ones are just the inverse. And folks, if you can't figure out how to do the total opposite of what's on the screen, you're going to have a hard time getting into this because it is fairly, I don't want to say it's like common sense because it's brand new and it's still something you're learning, but it is just the opposite. So we're looking at something called a bullish catapult. And these are the rules, all right? You have to follow these rules. These cannot be broken. Well, all right, just follow the rules. All right, so a catapult. First rule, it has to have at least a triple top or a triple bottom, okay? So there's a triple top. Next one is that price has to break out above it but it can only be between 1 and 3 boxes. 1, 2, or 3 boxes. No more than that. All right. And then we have to actually see it pull back. Okay. We have to see it pull back, retrace. This is, if you looked at this on a candlestick chart, it would look like a big fake out, right? Because the candles were moving above this line of resistance and it broke out. People were bullish, and then it not only retraced back and fell into the prior high, but now it moved down below. All right. But this is where the catapult, and it's like a spring, it's like a catapult, just shoots right up. Okay. Pullback must not generate a reversal, meaning that this column of O's, it can come down and form a triple bottom here, but if it moved 1 O lower, then it's no longer a catapult. It's the setup is invalidated. And the entry on the catapult is the when it forms the new double top, that's the entry. And so the nice thing about these kind of setups, folks, is that um, you know, pretend that all we ever saw was this column of O's. Well, you could put a buy stop above this X here, because you would know ahead of time that, okay, well, if there's a reversal column of X's that shows up, that you don't want to miss it. There you go. Pull patterns. Pull patterns are like the definition of volatile. Out of all of the point and figure patterns, this one is the most risky, and it is the one that requires the most attention. All right. Sorry. That was stuck in a spike pattern, not a pull pattern. Pull patterns. I was thinking of a spike pattern. A pull pattern is kind of like your bread and butter. Um, the pull pattern is something that shows up a lot, and this is where a lot of trades come off of too. But a pull pattern has to have at least 5 X's or O's above. Well, for X's, 5 X's above a multiple top, or 5 O's below multiple bottom. All right. So the column itself has to have less than 15, because if it's 15 or more, then it's a spike pattern. So pull patterns, because there's always two trades setups with the pull pattern. The first one is this, like right here, where we would short it. So you have this column of X's, it's less than 15, there were 5 X's above it. The short entry is as the break below 50% of this column's range. And if you're wondering how you could do that very easily, um, is to use like the Fibonacci tool. You can just, there's the top to the bottom of the column, there's your 50% level right there. All right. On the other side of that is, here's this pull pattern, this column of O's, and then we see the reversal column of X's show up. But what doesn't it do? It doesn't move to 50%. It doesn't move above 50% of the range of this column of O's. Instead, it reversed again. And the entry there is right on the 3-box reversal. All right. So this is essentially a pullback. Like if you're looking at a candlestick chart, this column of X's probably looks like a bearish pennant or a bear flag, or some derivative of that. Except in point figure, we're just seeing it as a column. And this is typically, what is this is a pretty normal type of pullback in a move south. Now the fake out pattern. Oh man, fake out patterns. They are a lot of fun. This is where it has to have 2 boxes. That's it. Not 1, not 3, not 5, but 2 boxes above a multiple top. Ideally, it would be at least a triple. That would be the ideal. So 2 boxes above a multiple top, or if this was the bearish one, actually this is the bearish setup. If it was the bullish one, it'd be 2 O's below the multiple bottom. And the entry on that is, this is kind of like a pull pattern. It's at 50% of the range of this column of X's. Shakeout. Oh man. These are, after catapults, these are my favorite, but these are kind of tricky, okay? Here's the rules. All right, so shakeout. Because there's bullish shakeouts and bear shakeout, but I'm showing you the bear shakeout. So it has to be in a downtrend. What does that mean? Well, I should have written to be in a downtrend. What does that mean? Well, I should have wrote bear market. This is where you would establish whether or not, um, the shakeout pattern is appropriate. If it's in a bull market and the shakeout pattern shows up, then it's a bullish shakeout setup. Then it's, I don't want to say it's safe, but it's going to have a higher success rate theoretically. But that must be in a downtrend. Must form a double bottom, and we have to see it reverse and then go 2 boxes above. It's like the false buy signal. This looks like what? This looks like the fake out, right? But on the shakeout, it's part of the broader down move, usually at the beginning of a downswing. I mean, if you notice that there's already 3 or 4 swings in a trend or in a bull market or bear market, um, I would skip the shakeout pattern because it's often if I remember correctly, its performance is mostly uh, successful if it's near the beginning of a new bull market or bear market in point and figure. But you have the false buy signal 2 boxes above, and then what we have on the entry is we shorted the 3 box reversal. So these do show up, and oftentimes I've kind of suggested that people look at catapults and shakeout patterns before anything else, like get used to those because a lot of the principles of the other patterns are really involved in those two. And then we have descending triple bottoms and ascending triple tops. It's very simple. I mean, you have this column of O's and then it reversed, came down, double bottom, broke down below there. So there's a second low. This is the next lower low, does the same thing, and then the entries right on that third low. Um, and the trap pattern, you have to have like a multiple bottom or a multiple top, and it's 1 box that breaks down. Now, I'm gonna say trap patterns. I don't often trap patterns show up all over the place. Um, but the thing is that they don't have the best uh return. Anderson's work showed that the ascending and descending, at least for the stock market, in point figure, the ascending triple bottom and the ascending triple top and the descending triple bottom had the best performance out of all of them. So, anyways, that is the intro to point and figure. Again, this will be I'll sticky the video up in the channel, and yeah, talk with y'all later. Bye bye.